Well, hi everyone. Buffett and Beyond Research brings you our hedged ETF portfolio, and right now it still is doubling the S&P 500 with much less risk. So let's get right on with it. And here we are. This is the S&P 500. Just show you know what we're doing in the market itself, and you can see these declining tops in here. And that's what has everybody worried. Now, right down here at this 4,100 level, we are looking at an area of support. Not much of a support, but it's the support. And today, as I'm recording this, which is Monday, we are doing very, very nicely to the upside. So we're bouncing off there, but we have to see it go up. We have to see it come back down and test that area once again, because when you get a fall like this, you want to see a type of testing that will give us the confidence to buy into this market. And down here, you can see that, maybe just see that this black line is turning up a little bit. That would be nice, because if we do, we can have a buy signal on this market. But this has to turn up. It can't go down any further. And the next couple of days will tell. Remember, Fed Chief Powell speaks on Wednesday. And just to let you know, because we don't talk about the 30 stock growth portfolio in this segment very, very much, but it's up 25% versus the S&P 7%. Actually, the S&P is up 7.1% as of last Friday. So we're looking at the low of the market for now anyway. And as I mentioned, these prices are on the close on Friday, October 27th, which was Friday. And yeah, 25% is a big, big deal relative to the S&P of 7%. And that's not a hedge portfolio unless you want it to be, with the Saturday market letter that we put out all the time. And you can hedge them with put options. And there's other options available for hedging a portfolio. But that's not for this letter. And let's look at the XLK. This was last week, and we can see the XLK, and these are candlesticks. The XLK went up to its 50-day moving average, stayed above it for a while, and then came barreling back down. And you can see this indicator down here was getting ready to give us a sell signal. Now, this week, well, it went down past that level, but Friday it didn't have a bad day at all. And this is this line right in here. And today it's doing very, very nicely. When we look at the semiconductor from last week, we see that it was falling down. It was taking a hard fall in here, and this indicator turned down, gave a sell signal. Now notice where we are at 179.58 right in here. And this week, as of Monday morning, I'm recording this, and this is down to 168, and you can see it doesn't want to stop going down for now. And this intermediate term indicator is just pointing straight down. However, the XSD has done very well this year, and we'll see that number in a minute. Now, let us look at how these 6 ETFs have been doing, non-hedged and hedged. Now, this is since the beginning of the year, so it's year to date that we're looking at this, and 10/28 was Friday's close. So we're looking at the tech. Now, these are just the ETFs returning this year. Technology up 28%, semiconductors up 39%, again, year to date. Transportation up 24%. Now, health, which is supposed to be defensive, doesn't seem to be very defensive at all, does it? And we have home builders and we have home construction. So they are in our 6 ETF portfolio. Now, from each of those, we take 5 or 6 or 7 stocks that are the best stocks according to the clean surplus methodology, and this is what the hedge portfolio has done. These are the returns, but let's look at the totals. Now, last week, the S&P 500 was up about 13.1% for the year. The non-hedged ETFs, the top stocks in those ETFs, up 33.7%, and our hedge stocks were up 17.1%. So you can see that we're getting a bigger bang for our buck with the hedge portfolio, because the downside is pretty well protected and the market, or the S&P 500, is not. Now, this week, the market, or at least as of last Friday, the market has returned, measured by the S&P 500, 7.3%. The non-hedge stocks, 21%, and you can see what a big drop over 1 week. And the hedge portfolio stocks were just down 4 percentage points. Now, what does that do as a percentage of the percentages from last week to this week? Well, the difference is the S&P fell 44.3%. If you just base it on last week's return and this week's return, that's 44%. It got cut in half. The S&P got cut in half between 2 weeks here, folks. and our fell 11 points. And when you base it on the 33% of last year, of last week, this is a 37% decline. Now, our hedge portfolios fell from 17.1% to 13.4%. So we're still up for the year, and we are doubling the S&P 500. Again, with these stocks falling last week, because we had hedges on, we were only down less than 4 percentage points, actually 3.8 percentage points, where the non-hedged were down 11.7 percentage points. And of course, the S&P was down 7 or 6 percentage points, but based on these numbers from last year, this is how we're figuring the declines just from last week. So again, you can see no matter how you look at this, the hedge portfolio is working very, very well. And over time, with all our research and all our portfolios, the stocks continue to do that. The ETF hedge portfolios continue to outperform. The non-hedge portfolios really outperform, but it's more volatile if they're not hedged. So you can have your choice, or you might hedge half the portfolio while you hedge all the portfolio. So there are several ways you can go about that. And folks, you want to see that no matter which portfolio we pick, as long as we pick the top stocks in each ETF, we're going to, or I should say, we will very, very probably outperform the S&P no matter which way we go. When you look at it a long term, we are always outperforming the ETFs that we do research on. Now, I just want to show you the utilities, and the utilities last week were down right around here, and they went up to make this high in here and have fallen back. And the utilities are supposed to be a defensive sector. Well, this is not very defensive, folks. When you look at this decline that we've had so far, you hardly call that a defensive portfolio. And this is because you are all emailing me and telling me that you hear it on television, you hear it all over the place, that utilities are safe. Well, they're safe until the market really gets wiry and sells off. So in the short term, yeah, they're pretty good. But over the long term, if the market gets a big decline, they're going to sell those utility stocks too. And then when we look at the XLV, which is supposed to be defensive, XLV is the healthcare sector. It's supposed to be defensive, and ouch, it is really taking a tumble in here. So when they say certain portfolios are defensive, they're defensive if you hedge them. Do they lose less than other parts of the market? Well, it depends on the market decline. And we never know what's coming. So if we did, we'd all be as rich as Buffett, and we're not. So therefore, we're looking at signals here that are not very good, but the market is at least up today, and this is Monday, I'm recording this, and we want to see some of these indicators turn here. But a lot of damage has been done, and the market is very, very oversold, so we do expect a rally in here. How far it will go, we just don't know. So, folks, we had a terrible week past week, one of the worst, with the S&P down 2%, the Dow down 2%, the NASDAQ down 2.5%. That's a big fall in 1 week. So anyway, folks, go out, clear your heads, forget about the market for a while. It'll be here when we get back, and so will your portfolios. All right, folks, stay safe, and we'll see you next time.